Emergency update. Fake silver crash. Revealed. 5B forced sell-off. Happening right now. As you watch this, $5 billion is being systematically extracted from the silver market. But this isn't what it appears to be. The headlines scream panic. The charts flash red. Retail investors are fleeing in terror. Yet, the world's most sophisticated institutions aren't selling. They're waiting. January 8th, 2026. A date that will separate those who understand market mechanics from those who react to market emotions. The greatest wealth transfer in commodity history is disguised as a crash, and you have exactly 48 hours. To position yourself on the right side of this, welcome to Currency Archive, where we decode the financial events that shape your economic future. If you've built your career on understanding how money truly works, if you remember when financial news required actual analysis, not just headlines, then you belong here. Take a moment, press that subscribe button below. This is information your peers need to see, and tell us in the comments. From which corner of the world are you watching this unfold today? New York, London, Singapore, Mumbai? Your perspective matters in this global financial chess game. Now, let's dissect exactly what's happening in the silver market, and why the next 2 weeks will define the next 2 years. The global financial markets are experiencing something that appears catastrophic on the surface, yet reveals itself as entirely mechanical upon closer examination. On Thursday, January 8th, 2026, silver prices are declining sharply, creating panic among inexperienced investors who mistake algorithmic selling for genuine market collapse. The spot price of silver currently sits at $75.62 per ounce. This represents a decline of $2.25 in a single trading session. The percentage drop stands at 2.9%. For those unfamiliar with commodity volatility, this number triggers fear. For those who understand market structure, this number signals opportunity. The primary force driving this price action has nothing to do with supply shortages or demand destruction. Instead, the market is witnessing the annual rebalancing of major commodity index funds. These funds operate under strict mathematical rules that govern billions of dollars in investment capital. Silver experienced an extraordinary performance throughout 2025. The metal surged over 160% during that calendar year. This exceptional gain created a technical problem for passive investment funds that track commodity indices. The most significant of these indices is the Standard & Poor's Goldman Sachs Commodity Index, commonly known as the GSCI. This index tracks 24 different commodities. When one commodity outperforms dramatically, it becomes overweighted within the index structure. Fund managers who oversee passive portfolios do not have the discretion to simply hold an overweighted position. Their legal documents, known as prospectuses, mandate specific actions. These managers must sell the winning asset to bring portfolio weights back to predetermined target levels. This creates a paradoxical situation that defies common investment logic. The best performing commodity of the previous year becomes the asset that must be liquidated, not because it is failing, but precisely because it succeeded. Analysts at TD Securities have calculated the exact magnitude of this forced liquidation. Approximately 13% of the total open interest in COMEX silver futures must be sold over the next 2 weeks. This represents a massive volume of paper contracts hitting the market simultaneously. The critical detail that separates informed investors from panicked traders lies in understanding what is actually being sold. These are paper derivatives, not physical metal leaving secure vaults. The distinction between paper price and physical inventory becomes crucial during periods of extreme volatility. This $5 billion sell-off dominates current trading desk conversations across Wall Street. However, this selling pressure lacks discretion or market timing consideration. The algorithms simply execute. They sell because they must, not because the fundamental value of silver has changed. The mathematics behind this process are inflexible. Passive funds cannot choose to wait for better market conditions. They cannot analyze economic data and decide to hold. Their mandate removes human judgment from the equation entirely. Meanwhile, gold presents a completely different picture. The gold spot price remains remarkably stable at $4,456.98. Gold trades essentially flat with only a 0.1% gain. This stability highlights that today's market action specifically targets silver, not the broader precious metals complex. The gold to silver ratio currently expands to approximately 58-1. This means 1 ounce of gold purchases 58 ounces of silver at current market prices. This ratio serves as a critical diagnostic tool for professional traders. The widening spread indicates that silver leads the profit-taking movement in precious metals. Arbitrage traders view this ratio expansion as a temporary anomaly. They recognize that the index rebalancing creates artificial price distortion. The ratio will eventually contract once the mechanical selling concludes. Support levels are being tested at $75, a psychological barrier in commodity markets. Historically, round numbers trigger algorithmic buying programs. Computer systems are programmed to recognize these levels and execute purchase orders automatically. Technical indicators confirm the severity of the selling pressure. The relative strength index on the 4-hour chart has dipped into oversold territory. This mathematical indicator suggests that the mechanical selling approaches its natural limit. The selling pressure is expected to persist through the remainder of Thursday's trading session. It may continue into the early hours of Friday, January 9th. However, market structure analysis suggests that the majority of rebalancing will be front-loaded into these initial 48 hours. Smart money institutions understand this dynamic completely. They are not participating in the selling. Instead, they wait on the sidelines. They recognize that artificial supply will eventually exhaust itself. Once the index funds complete their mandatory sales, the market returns to genuine supply and demand fundamentals. This is not a crash based on economic deterioration. This is a mechanical reset designed to equalize portfolio risk within passive investment structures. The true market begins after the algorithms finish executing. While trading algorithms execute their predetermined selling programs in New York, the physical world is writing a completely different narrative. The events unfolding across international waters and sovereign territories are creating a price floor that algorithms cannot comprehend. Breaking news from the North Atlantic has sent shockwaves through diplomatic channels. The United States military has seized 2 additional oil tankers with direct links to Venezuela. The seizure itself would be significant enough, but one critical detail elevates this event to a different category entirely. One of these vessels was operating under a Russian flag. This is not a routine enforcement action. This represents a direct confrontation between Washington and Moscow over energy resources. The involvement of a Russian-flagged vessel brings a nuclear-armed power into the equation. Geopolitical analysts recognize this as a fundamental shift in how resource conflicts will be conducted in 2026. His rhetoric targets Colombia specifically, a nation he recently described as the sick man of Latin America. The language being used suggests military intervention is not merely possible, but perhaps inevitable. The administration has moved to control Venezuelan oil sales indefinitely. The stated justification revolves around national security concerns and energy independence. However, seasoned observers recognize this for what it truly represents. Venezuela holds the largest proven oil reserves on the planet. Control over these reserves means control over global energy pricing for decades to come. Every time a tanker is seized, every time a new military threat is issued, a predictable pattern emerges in commodity markets. Capital flows into safe haven assets with remarkable speed. Gold and silver become the immediate beneficiaries of geopolitical uncertainty. This creates a natural counterforce to the index fund selling pressure. The market is witnessing 2 opposing forces colliding in real time. On one side, passive funds mechanically sell silver to meet rebalancing requirements. On the other side, geopolitical buyers aggressively accumulate the metal as protection against escalating conflicts. The United States has turned its attention toward Greenland with renewed intensity. The interest is not territorial for its own sake. Greenland contains vast deposits of rare earth minerals that are essential for modern technology production. These same technology sectors consume over 50% of the annual global silver supply. The strategic importance of Greenland cannot be overstated. If the United States moves to purchase or secure these resources, it signals a fundamental shift toward resource nationalism. This benefits all tangible commodities, but particularly those with dual purposes as both monetary metals and industrial materials. Silver occupies a unique position in this new geopolitical landscape. It is not merely a precious metal that investors hold for wealth preservation. Silver is a strategic material required for the guidance systems and advanced electronics used in modern military hardware. The conflict in the North Atlantic serves as a reminder that global trade routes exist at the mercy of naval powers. Shipping lanes that appear permanent can be disrupted within hours by military action. Investors watching these developments understand the implications immediately. The president's rhetoric suggests a return to a more assertive interpretation of the Monroe Doctrine. This 19th century policy asserted United States primacy over the Western Hemisphere. The modern version appears to involve absolute control over regional resources, particularly energy commodities. This political stance reduces reliance on international cooperation. It increases the value of assets that do not depend on another party's promise. Physical silver stored in a secure vault does not require diplomatic relations to maintain its value. It does not need functioning international banking systems. It simply exists. Oil traders are interpreting the tanker seizures as a potential precursor to a full blockade. Such an action would send energy prices into unprecedented territory. Higher energy prices have a direct mathematical relationship with silver prices. Mining operations require enormous energy inputs. Refining the metal demands even more. As energy costs rise, the marginal cost of silver production increases proportionally. The Venezuelan gambit represents a play for the largest oil reserves in the world. Market participants understand the stakes involved. This is not about short-term price fluctuations. This is about control over the fundamental resources that power industrial civilization. Amidst this chaos, the decline in silver prices to $75.62 appears disconnected from reality. The mechanical index rebalancing becomes a distraction. The real story unfolds at sea, where military vessels enforce new rules about who controls vital commodities. Smart money interprets these events through a different lens. The United States government is signaling its willingness to use force to secure strategic materials. This fundamentally alters the risk profile of holding paper currency issued by any government. In a world where tankers are seized and nations face military threats, the anonymity and portability of precious metals become their most valuable attributes. Silver can be moved, stored, and traded without requiring permission from regulatory authorities. The geopolitical safety net explains why silver has not collapsed below $70, despite $5 billion in forced selling. There is a persistent bid underneath the market. This bid comes from entities seeking protection against the escalation of multiple simultaneous conflicts. The convergence of the Venezuelan oil crisis, Colombian tensions, and Greenland mineral acquisition creates perfect conditions for hard asset appreciation. The floor holds because reality holds. The numbers tell a story that most market participants are actively ignoring. Deep within the mathematical relationships between metals lies a structural imbalance that cannot persist indefinitely. This imbalance represents the collision point between geological reality and human financial engineering. The current gold to silver ratio stands at 58-1. This means an investor must exchange 58 ounces of silver to acquire a single ounce of gold at today's market prices. On the surface, this appears to be merely a trading ratio. Beneath the surface, it reveals a profound disconnect from physical reality. Nature does not respect financial ratios determined by trading algorithms. In the Earth's crust, silver and gold exist in an approximate ratio of 8-1. For every ounce of gold that exists in geological formations, roughly 8 ounces of silver are present. This natural abundance ratio has remained consistent for millions of years. The gap between 58-1 and 8-1 represents a market dislocation of extraordinary magnitude. Historical analysis shows that the gold to silver ratio typically gravitates toward 30-1 during stable market periods. For this ratio to return to its historical mean, silver would need to nearly double in price, assuming gold remains static at current levels. However, gold is not remaining static. Gold trades steadily above $4,400 per ounce. The monetary forces driving gold higher are simultaneously pulling silver along in its wake. Yet silver moves more violently in both directions due to its smaller market size and dual nature as both monetary metal and industrial commodity. Industrial demand for silver continues to accelerate regardless of short-term price fluctuations. The photovoltaic solar energy sector alone consumes nearly 30% of annual global mining supply. This percentage is not declining. Industry projections indicate this consumption will increase as efficiency standards evolve. The newest generation of solar panels is being designed with a critical modification. Engineers are increasing the silver content per panel unit to achieve higher electrical conductivity. This design change creates a tightening constraint on physical supply that mathematical models are only beginning to capture. The solar industry's appetite for silver intersects with another massive industrial transformation. The electric vehicle revolution is transitioning away from traditional lithium-ion battery technology. The next generation involves solid-state batteries, many of which utilize silver-carbon composite materials for enhanced performance characteristics. Automotive manufacturers are making decade-long commitments to these technologies. Their supply chain managers are currently negotiating long-term silver supply contracts. These contracts lock in physical metal for years into the future, removing it from the available market supply before it even leaves the ground. This industrial squeeze is colliding directly with monetary demand, driven by the geopolitical instability examined in the previous section. The market is being compressed from two directions simultaneously. Industrial users need physical silver for manufacturing processes. Monetary buyers need physical silver for wealth preservation. Both groups are competing for the same finite annual production. The current price of $75.62 represents a battleground. On one side stand the paper market participants, looking backward at 2025's gains and executing algorithmic selling. On the other side stand physical market participants, looking forward at supply constraints and executing strategic accumulation. Short sellers are currently enjoying the mechanical price decline. They have positioned their trades to profit from falling prices. However, these traders face a looming threat that keeps sophisticated risk managers awake at night. If physical inventory becomes scarce, a short squeeze becomes inevitable. A short squeeze occurs when traders who have sold contracts they do not own are forced to purchase them at any available price to close their positions. In commodity markets with tight physical supply, short squeezes can be violent and swift. The 13% of open interest being sold by index funds will eventually be absorbed by the market. This selling represents a finite amount. Once this overhang is removed, the path of least resistance for silver prices shifts dramatically upward. Market technicians are identifying the next psychological level at $100 per ounce. Round numbers act as magnets in commodity trading. The human psychology embedded in trading algorithms creates natural attraction points at these levels. The volatility witnessed on January 8, 2026 is characteristic of markets attempting to find equilibrium in an environment of currency debasement. Central banks globally have expanded money supplies by trillions of units over the past several years. This expansion creates the backdrop against which commodity prices must be evaluated. Investors must develop the ability to distinguish between price and value. Price is what appears on trading screens, determined by leverage ratios and algorithmic execution. Value is determined by scarcity, utility, and the replacement cost of physical production. Data that mainstream financial media consistently ignores tells the real story. Physical vaults in London and New York are experiencing steady drainage. Metal is moving from Western financial centers to Eastern manufacturing centers. Metal is transferring from public exchanges accessible to many to private vaults accessible to few. This migration pattern of physical metal contradicts the declining paper price. The disconnect between paper price discovery and physical metal movement cannot exist indefinitely. Eventually, the market must clear at a price that balances physical supply with physical demand. The market stands at a crossroads. Short-term technical indicators flash bearish signals as algorithms execute selling programs. Long-term fundamental analysis has never presented a more bullish case for silver ownership. The path toward $100 silver is not a straight line. It is constructed with volatility, specifically designed to eliminate participants who lack conviction. The uncommitted are being shaken from their positions. The committed are accumulating. The world is fragmenting before our eyes, yet most market participants remain fixated on trading screens rather than the structural transformation occurring beneath the surface. The seizure of Russian-flagged assets in international waters represents far more than a headline. It represents a fracture in the global financial architecture that has governed commerce for decades. When the United States military seizes vessels flying Russian flags, it sends an unmistakable signal to every nation conducting international trade. The rules that governed global commerce since the end of World War II are being rewritten in real time. Nations watching these events understand that reliance on dollar-denominated trade carries risks that previous generations never contemplated. This fracturing accelerates the trend that financial analysts have labeled de-dollarization. Countries are actively seeking alternatives to conducting trade in United States currency. They recognize that access to the dollar system can be revoked as easily as it was granted. When access becomes a weapon, smart nations seek alternatives. Silver occupies a unique position in this emerging multipolar world. Throughout history, silver has functioned as a neutral settlement medium for international commerce. When trust between nations erodes, physical commodities bridge the gap that paper promises cannot. A bar of silver holds identical value whether presented in Beijing, Moscow, or New York. The formation of competing trade blocs is accelerating this process. Nations are grouping themselves based on shared interests rather than historical alliances. These new alignments require new methods of settling trade imbalances. Physical commodities become the obvious solution when counterparty trust disappears. The United States government's aggressive posturing regarding Greenland reveals a critical recognition by strategic planners. The statement has been made repeatedly in classified briefings that critical minerals represent the oil of the 21st century. Nations that control these resources will determine the shape of global power structures for generations. Silver is the most electrically conductive element known to science. This is not a marketing claim. This is a physical property that cannot be replicated by substitutes. Every smartphone, every computer, every advanced weapon system, every electric vehicle relies on silver's unique conductivity. There is no replacement that matches its performance characteristics. The electronics that define modern existence cannot function without silver. As technology advances, the demand for this irreplaceable metal increases proportionally. Engineers cannot design around this requirement. They can only accept it and secure supply. January 2026 will likely be remembered as a pivotal accumulation moment for investors who understand market mechanics. The Great Rebalance Trap is functioning exactly as designed. Algorithmic selling creates panic among those who react to price movements. Strategic buyers use this panic to accumulate positions at discounted levels. Those who sell silver today because of a mechanical index adjustment are surrendering their positions to entities playing a fundamentally different game. Retail investors see a declining chart and fear further losses. Institutional strategists see a temporary dislocation between price and value and recognize opportunity. This transfer of positions from weak hands to strong hands occurs during every major market transition. The weak hands are governed by fear and recent price action. The strong hands are governed by long-term strategy and understanding of market structure. Historical patterns are remarkably consistent in this regard. Investors who panic during index rebalancing events typically find themselves buying back positions at significantly higher prices once the dust settles and the underlying trend reasserts itself. The emotional cost of this pattern extends beyond financial losses. It creates psychological scars that prevent future participation. The clearing of excess leverage from the system is a necessary process. Markets cannot sustain parabolic rallies without periodic consolidation. The consolidation phase removes over-leveraged positions and allows for more sustainable price appreciation going forward. As the index rebalancing concludes over the next 2 weeks, market attention will refocus on the forces that ignited the rally initially. Inflationary pressures have not disappeared. Geopolitical risks have intensified rather than diminished. The fundamental case for owning hard assets strengthens daily. The current price decline is a function of market structure, not market sentiment. It certainly does not reflect the metal's intrinsic worth or its strategic importance to modern civilization. This distinction separates those who will profit from this moment from those who will regret their actions. The $75 support level represents a line in the sand for institutional buyers. Trading volume analysis shows significant accumulation occurring at this price point. Large orders are being filled quietly, while retail investors focus on the declining price. Resource nationalism is not a temporary trend. It represents a fundamental shift in how nations approach commodity security. The days of assuming free trade and open markets are ending. The new era involves securing physical resources through whatever means necessary, including military force. Silver exists at the intersection of multiple critical trends. It is simultaneously a monetary metal, an industrial commodity, and a strategic material. No other element occupies this unique position across so many essential categories. The story of silver in 2026 is the story of a finite resource trading within an infinite sea of paper currency and escalating geopolitical chaos. The contrast between these two realities cannot be starker. Professional analysts focus on data rather than noise. They watch physical flows rather than paper price fluctuations. They understand that algorithms generate noise while physical scarcity generates value. The volatility of January 8, 2026 is not the end of the silver rally. It is the pause before the next leg higher. Markets never move in straight lines. They advance through a series of consolidations that eliminate weak participants. The path to $100 silver is paved with exactly this type of volatility. It is designed to be uncomfortable. It is structured to create doubt. It functions to separate those with conviction from those without. The mechanical storm is temporary. The structural drivers are permanent. This is not the end. This is the reset before the acceleration.